stocks and bonds. Good day everyone! In today's lesson, we are going to disclose the ideas behind the terms stocks and bonds. In order to disclose the ideas behind stocks and bonds, here are the objectives of this lesson. At the end of this session, the learner will be able to define stocks and bonds, differentiate stocks and bonds, calculate dividend per share, market value and stock yield ratio, calculate coupon rate, price of the bond, face value or par value, term of bond, fair price of a bond. Financial risk is the chance you take of making or losing money on an investment. For prospective investors and many others, it is important to distinguish between bonds and stocks. In order to obtain the objectives, Isabelita Flores will be discussing about the definition of stocks and bonds. Jemar Olivera will be discussing the second objective, which is about the difference between stocks and bonds. Aubrey John Palio will be discussing the third objective on how to calculate dividend per share, market value, and stock yield ratio. And lastly, Pablito Aparici will be the one to discuss the fourth objective on how to calculate coupon rate, price of the bond, face value or par value, term of bond, fair price of a bond. To start, I will give the floor to Isabelita Flores.
Hello! In order to attain this first objective of this lesson, I am going to give you an overview of the stock and bonds and an application in real life. To understand which investments are more suitable for an individual investors, one must understand what the securities are, the return that they provide, and the risk that they carry. Stocks. Stocks represent ownership or equity in a company by Davis 2022, issued by the sole proprietors, partnership, and corporations. The basic idea behind the stocks is that an entity needs to raise money and can sell stocks or share in return for the required funds. In return, the company gives investors a portion of ownership in the company, entitling the excess earnings and enabling them to make ownership decisions such as voting or on management. Stocks do not provide a fixed amount of return. In fact, the return that they yield can fluctuate very significantly. The investors become the part owner. Bonds. Bonds are debt instruments and can be considered IOUs or loans. The basic idea behind a bond is that an entity needs to raise money and therefore can sell a bond in return for the required funds. In return, they promise to pay back the initial amount that they borrowed. In addition to interest, interest represents the compensation rate that the investors, who is lender in this situation, requires. They are also called fixed income instruments because they provide a fixed amount of return which comes in the form of interest. The investors become the creditor. Many companies offer two classes of stocks to appeal to different types of investors. Here are the types of stocks. Number one, common stocks. An investor shares directly in the success or failure of the business. A type of tradable asset or security that equates to ownership in a company. If you own a common stock in company, you have the right to vote on things like corporate policies and board of directors decision. Common stock is just one type of stock traded on public exchange. Number two, preferred stocks. The dividends are fixed regardless of how the company is doing, issued with or without a par value. A type of stock that has characteristic of both bonds and stocks, like bonds, preferred shares, make a cash payouts, often a higher yield than bonds, while offering higher dividends return and less than common stocks. The type of bonds. Number one, treasury bonds. Treasury bonds are government securities that have 20 or 30 years term and they pay a fixed interest rate on a semi-annual basis. They can earn interest until maturity and the owner is also paid a par amount or the principal when the treasury bond matures. Number two, corporate bonds. Corporate bonds represent the number one source of corporate borrowing for both large and small companies. Bond buyers are lending money to the company while the company has a legal obligation to pay interest as agreed to bondholders. When the corporate bond matures or reaches the end of the term, the company repays the bondholder. Terms to aid in relation to stock. Dividend. Dividend part of the profit of a company that is paid to shareholders. Dividend per share, the total dividends declared in a period divided by the number of outstanding ordinary shares issued. Stock market. Stock market, a place where shares of public listed companies are traded. Market value. The market value, the term used to describe how much an asset or a company is worth on the financial market according to market participants. To calculate the market value of a company, you would take the total shares outstanding and multiply the figure by the current price per share. Stock yield ratio, calculated by dividing the dividend per share by stock price divided by market value. Par value, the fair share amount as stated on the company certificate, unlike market value, it is determined by the company and remains stable over time. The original cost of the stock as listed on the certificate. Bond. Bond fixed income instrument because they provide a fixed amount of return which comes in the form of interest. Coupon. A coupon statement of due to be caught from a bearer bond when payable and presented for payment, usually received and semi-annually. Coupon rate. The annual income an investors can expect to receive while holding a particular bond. It is fixed when the bond is issued and is calculated dividing the sum of the annual coupon payments by the par value. At, at the time it is purchased, a bond yield to maturity and its coupon rate are the same. Price of a bond. The presented discount value of future cash stream generated by a bond. The sum of the present value of all likely coupon payments plus the present value of the par value at maturity. To calculate the bond price, one has to simply discount the known future cash flows. Par value, the amount paid to the holder at maturity. If P equals F, the bond is purchased at par. And if P less than F, the bond is purchased at a discount. And if P is greater F, the bond is purchased at premium. Term of a bond, the amount of time between bond issuance and bond maturity. On the maturity date of a term bond, the bond's face value, the principal amount, must be repaired to the bondholders. Fair price of a bond, percent value of all cash inflows to the bondholder. Any questions or clarifications?
So now that we are knowledgeable about stock and bonds and the terms associated to it, we are now going to identify their differences and similarities if there are any. For prospective investor and many others, it is important to distinguish between bond and stocks. Two of the most common asset classes for investment are bonds, also known as fixed income instrument, and stocks, also known as equities, CFI Team 2002. Stocks. The company sells part of itself in exchange for cash. Risky and volatile, but can provide high long-term returns. Represent ownership in company. Provide the owner with voting rights in a company except preferred stocks. Not all stocks pay in dividend. Most stocks are traded on a stock exchange. Bonds. The entity gets loan from the investor and pays it back with interest, tend to be low risk and low reward, with some exceptions, represent debt. Bondholders have no voting rights. All bond pay regular interest. Bond interest is guaranteed. Most bonds trade over the counter. In the case of bankruptcy, bondholders have a higher claim on the company's assets and are more likely to get some of their money back. Similarities of bond and stocks. Financial securities sold to investors to raise money. An investment that can be easily converted into cash. Corporations often issue equity to raise cash to expand operations. And in return, investors are given the opportunity to benefit from future growth and success of the company. Buying bonds means issuing a debt that must be repaid with interest. You won't have any ownership stake in the company, but you enter into an agreement that the company of government must pay fixed interest over time as well as the principal amount at the end of the period. To make money from stocks, you'll need to sell the company's share at higher price than you paid for them to generate a profit or capital gain. Fixed income. Bonds generate cash through regular interest payments. The distribution frequency can vary, but it's generally as follows. Treasury bonds and notes, every 6 months until maturity. Treasury bills, only upon maturity. Corporate bonds, semi-annually, quarterly, month, or at maturity. Risk. The biggest risk of stock investment is a share value decreasing after you purchase them. Stocks are much more volatile and there is a higher chance of losing your investment since equity holders are subordinated to debt holders if a company is forced to liquidate. Fixed income investments are much less volatile than stocks and also much less risky. However, bonds have a lower potential for excess returns than stocks do. Distinguish between stocks and bonds. Stocks, a form of equity, financing or raising money by allowing investors to be part owners of the company, while the bonds is a form of debt, financing or raising money by borrowing from investors. Stocks prices are very varied every day. These prices are reported in various media, newspaper, TV, internet, and etc. Bonds investors are guaranteed interest payments and return of their money and the maturity date. Investing in stock involves some uncertainty. Investor can earn if the stock prices increase, but they can lose money if the stock prices decrease or worse, if the company goes bankrupt. While in bonds, uncertainty comes from the ability of the bond issuer to pay the bond holders. Bonds issued by government pose less risk than those companies because of the government has guaranteed funding taxes which is can pay its loans. Higher risk but with possibility of higher returns. In bonds, lower risk but lower yield. In stock, can be appropriate if the investment is for the long term, for example 10 years or more. This can allow investors to wait for stock prices to increase if ever they go low, while in bonds can be appropriate for retirees because of the guaranteed fixed income or for those who need the money soon because they cannot afford to take a chance at the stock market. Ask questions or clarification. Number 1. What is the difference of stock and bonds when it comes to risk? Number 2. What can stock and bonds purchase? Number 3. What is the similarity between stocks and bonds? Number 4. As an amateur investor, where would it be safer to invest? In stocks or in bonds? Now that you already know the definition of stock and bonds, you are now ready for the next part of the lesson, which is about the differences and similarities of stock and bonds to be discussed by Obrijan Valio.
With the prior theoretical knowledge, we are now going to proceed to obtain our third objective. which is to calculate dividend per share, market value, and stock yield ratio. Before beginning to calculate, we must remember first the terms in relation to stocks. Number 3, definition of terms in relation to stocks. Stocks, share in the ownership of a company. Dividend, share in the company's profit. Dividend per share, ratio of the dividends to the number of shares. Stock market, a place where stock can be bought or sold. The stock market in the Philippines is governed by the Philippine Stock Exchange, at what we call PSE. Market value, the current price of a stock at which it can be sold. Stock yield ratio, ratio of the annual dividend per share in the market value per share, also called current stock yield. Par value, the per share amount as stated on the company certificate. Unlike market value, it is determined by the company and remains stable over time. Give examples to illustrate these terms. Example number 1. A certain financial institution declared a 30 million pesos dividend for the common stocks. If there are a total of 700,000 shares of common stocks, how much is the dividend per share? Given, total dividend equals 30 million pesos. Total shares, 700,000. Find the dividend per share. Dividend per share equals to total dividend over total shares. Then the total dividend is 30 million over 700,000, and that is total shares, equals to 42.86. Therefore, the dividend per share is 42.86 pesos. Example number 2. A certain corporation declared a 3% dividend of stock with a par value of 500 pesos. Mrs. Lingan owns 200 shares of stock with a par value of 500 pesos. How much is the dividend she received? Solution. Given dividend percentage is 30%. Stop. Okay, pa yung go play. Solution. Given dividend percentage equals to 3%. Par value equals to 500 pesos. Number of shares equals to 200. And we have to find the dividend. The dividend per share is 500 pesos times 0.03, that is 3%, equals to 15 pesos. Since there are 300 shares, the total dividend is 15 pesos per share times 200 shares equals to 3,000 pesos. In summary, dividend equals to dividend percentage times par value times number of shares equals 0.03, and that is 3%, times 500 pesos times 200 shares equals to 3,000. Thus, the dividend is 3,000 pesos. Example number 3. Corporation A with a current market value of 52 pesos gave a dividend of 8 pesos per share for its common stock. Corporation B with a current market value of 95 pesos gave a dividend of 12 pesos per share. Use the stock yield ratio to measure how much dividend shareholders are getting in relation to the amount of invested. Solution. Corporation A. Given dividend per share equals to 8 pesos. Market value equals to 52 pesos. And we have to find the stock yield ratio. So stock yield ratio equals to dividend per share over market value. And we have to substitute dividend per share equals 8 over 52, that is market value, equals to 0.1538, equals 15.38%. And Corporation B, given dividend per share equals to 12 pesos, market value equals to 95 pesos, and we have to find the stock yield ratio also. Stock yield ratio equals to dividend per share over market value, again, equals 12 over 95 equals to 0.1263, equals to 12.63%. Corporation A has a higher stock yield ratio from the Corporation B. Thus, each peso would earn you more if you invest in Corporation A than in Corporation B. If all other things are equal, then it is wiser to invest in Corporation A. As example 3 shows, the stock yield ratio can be used to compare 2 or more investments. Modular Manufacturing Incorporation has 2,500,000 shares of common stock outstanding. If a dividend of $4 million was declared by the company directors last year, what are the dividends per share of common stocks? So we have the formula here. Dividend per share equals to total common dividend over number of shares. And we have to substitute the total common dividend is 4 million over number of shares, 2,500,000 equals $1.60 per share. After performing of all the calculations, I can now see that you already know how to illustrate the terms related to stocks. Let us now proceed to illustrating the terms related to bonds to be discussed by Pablito Aparici.
Now that we already know how to calculate dividend per share, market value, and stock yield ratio, let us now proceed to learn on how to calculate coupon rate, price of the bond, face value or par value, term of bond, and fair price of a bond. So, to attain the objective, let us again remember some terms in relation to bonds. Definition of terms in relation to bonds. Bond. Interest-bearing security which promises to pay. First, a stated amount of money on the maturity date, and second, regular interest payments called coupons. So, coupon is a periodic interest payment that a bondholder receives during the time between purchase date and maturity date, usually received semi-annually. Coupon rate, the rate per coupon payment period, denoted by R. Price of a bond, the price of the bond at a purchase time, denoted by P. Par value or face value, the amount payable on the maturity date, denoted by F. So FP is equal to F, the bond is purchased at par. If P is lesser than F, the bond is purchased at a discount. If P is greater than F, the bond is purchased at premium. Term or tenor of a bond, fixed period of time in years at which the bond is redeemable as stated in the bond certificate. Number of years from time of purchase to maturity date. Fair price of a bond, present value of all cash inflows to the bondholder. So let's give an example to illustrate these terms. So example number 4. Determine the amount of the semi-annual coupon for a bond with a face value of 300,000 pesos that pays 10% payable semi-annually for its coupons. Given we have face value which is equal to 300,000 pesos and a coupon rate which is equal to 10%. Let's find the amount of the semi-annual coupon. So in getting the annual coupon amount, let's multiply the face value and the coupon rate, which is equal to 300,000 pesos multiplied by 0.10. So the result is 30,000 pesos. And then in getting the semi-annual coupon amount, which is equal to 30,000 multiplied by 1/2 is equal to 15,000. Thus, the amount of the semi-annual coupon is 15,000 pesos. The coupon rate is used for computing the coupon amount, usually paid semi-annually. It is not the rate at which money grows. Instead, current market conditions are reflected by the market rate and is used to compute the present value of the future payments. Example number 5. Suppose that a bond has a face value of 100,000 pesos and its maturity date is 10 years from now. The coupon rate is 5% payable semi-annually. Find the fair price of this bond assuming that the annual market rate is 4%. So given, we have the face value which is equal to 100,000 pesos and a coupon rate which is equal to 5%. Time to maturity is equal to 10 years. Number of periods is 2 multiplied by 10 years is equal to 20. and then the market rate is equal to 4%. So find the fair price of the bond. So amount of semi-annual coupon is 100,000 multiplied by 0.05 divided by 2 is equal to 2,500. The bondholder receives 20 payments of 2,500 pesos and 100,000 pesos at T is equal to 10. Present value of 100,000 pesos. So P is equal to F over the quantity of 1 plus J raised to N is equal to 100,000 divided by the quantity of 1 plus 0.04 raised to 10 is equal to 67,556.42. The present value of 100,000 pesos. Let's convert 4% to equivalent semi-annual rate. The quantity of 1 plus 0.04 raised to 1 is equal to the quantity of 1 plus I raised to 2 over 2 raised to 2, which is equal to I raised to 2 divided by 2 is equal to 0.019804. Thus P is equal to R multiplied by 1 minus the quantity of 1 plus J raised to negative N over J will result to 2,500. So 1 minus the quantity of 1 plus 0.019804 raised to negative 20 over 0.019804 which is equal to 40,956.01, and price is equal to 67,556.42 plus 40,956.01 is equal to 100,512.43. Thus, a price of 108,512.14 is equivalent to all future payments assuming an annual market rate of 4%. Now that you know how to illustrate the terms related to bonds, we are now all set to assess ourselves whether or not we gained all the objectives that we want to achieve after this learning session. In order to assess yourself whether you have attained all the objectives, here are questions and sample equations for you to answer. So first, modify true or false. Write true if the statement is true. Write the correct answer at the space after the statement if false. Test 2, matching type. Match the terms in column A with a correct definition in column B. Then in test 3, we have the solving in stocks and bonds. To wrap everything up, the main difference between stocks and bonds is that stocks give you partial ownership in a corporation, while bonds are a loan from you to a company or government. Stocks pose a higher risk compared to bonds, but provide a higher long-term results compared to bonds, which is fixed income investment that has lower returns yet less risky. Before ending this wonderful journey of learning, here's a quote from Anthony J. D'Angelo. Develop a passion for learning. If you do, you will never cease to grow. Thank you and God bless.